All right, let's get started. So I think the last people are still slowly coming in, but I think we can give it a go. So welcome to this webinar on how to report on the ESRS after the double materiality assessment. So my name is Matthijs van der Mars, and I'm sitting next to Jasper Akkermans. You want to introduce yourself, Jasper?
Welcome everyone. I'm Jasper. I'm the sustainability researcher at Coolset, and for almost a year now, I've been working on CSRD, making sense of it, translating it to a software tool within Coolset, but also deeply understanding all of the intricacies. So I'm really happy to be explaining some of those elements today and to answer your questions afterwards.
Perfect. Today is a webinar on how to report on the ESRS. It's a series of webinars on CSRD wide topics. So a couple months ago, me and Jasper hosted one about the double materiality assessment in general, after which Laurens, another colleague of ours, and Jasper hosted one together on the research phase of the double materiality assessment. And now we're going to take the step from the double materiality assessment towards the ESRS topic disclosures. You notice here the common denominator is Jasper. He's our expert together with a wider sustainability research team, which is making sure that Coolset is up to date on the latest legislations, such as the very recent update on the Dutch law, but also European-wide. So today, the plan for today is firstly to do a short recap of some relevant points from previous webinars that are related to the further topic today. So we quickly discuss what is double materiality, the impact on financial materiality, understanding the ESRS topics, thresholding, reporting the DMA, double versus single materiality, disclosing the ESRS topics, phased-in disclosures, auditing, and towards the end, I'll quickly discuss how Coolset helps you through this process. Finally, we'll close up with a Q&A session. So if you already have questions, you can post them into the chat, and we'll try to cover all of them at the end and answer them as well as possible. If we don't end up answering all of them, we can get back to you via email. So we'll post our email addresses at the end as well. So to start with the recap, what is the double materiality assessment? So it's the first part of the corporate sustainability reporting directive that we're all getting familiar with better and better. At least we're trying to, and of course, me and Jasper are going to try and help today. So it's the first step of this annual process of sustainability reporting that's starting, and it's really the selection part of or the selection methodology in which you determine which topics are material between the 10 ESRS topics. Of course, there's the 5 environmental, the 4 social, and the 1 governance topic, which together make up ESG. So there's a direct quote here from the EFRAG. The ESRS do not mandate a specific process or sequence of steps to follow when performing the materiality assessment. And so this is left to the judgment of the undertaking. What this means is that there's some ambiguity, or there's some interpretation left for the organization itself to determine how they're going to take on this process. But the double materiality does have some key elements that need to be included, and they mainly revolve around impacts, risks, and opportunities, or IROs from here on out. So there's 2 materialities. There's impact materiality and financial materiality. Impact materiality always precedes the financial materiality assessment, and it revolves around impact, which makes sense. And it's broken down into actual positive and actual negative impacts, and potential positive and potential negative impacts. Well, they're scored on 4 characteristics. You see here scale, scope, irremediability, and likelihood, which you can see at the top right corner of this slide. And they are conducted on 3 levels, the topic, subtopic, and sub-subtopic level. We actually have a double materiality assessment guide that we wrote, and I'll share the link to that in the chat later, so you can read this on your own time, a little bit slower than how we're going through it today. Additionally, I want to add here is that we are going through these topics really quickly in the recap. So if you're interested in the slides or recording of previous webinars, also shoot us an email, and we'll make sure to get that to you, so you can go through it on your own time. One thing that's also important to note here is that the double materiality assessment is used to determine which topics are material, but an in-depth impact assessment is not always necessary. So you can imagine that a company that works with the producing of toxic waste does not have to determine whether pollution is material or not. They already know, and then they can go into depth in the ESRS topic disclosure itself, and not necessarily in the DMA process. Then financial materiality. So this builds on the findings that were found in the impact materiality assessment. An example here, if the impact materiality assessment reveals that employees have bad work-life balance, which is a subtopic of the ESRS S1, then a future financial risk might be an employee shortage. So it really builds on the findings that you found previously in the impact materiality. It assesses both risks and opportunities, and there it considers two factors: magnitude and likelihood. And there's several time frames that are considered here, with short term, medium term, and long term being less than a year, between 1 and 5 years, or more than 5 years. And then what this results in is the selection of the ESRS topics, as was mentioned before. And there's 10 topics, as you know. There's 37 subtopics and 72 subtopics. An example here is ESRS S1, so that's own workforce, which has a subtopic called working conditions, which in turn has 8 subtopics, such as working time and work-life balance. And the IROs have to be broken down into the individual levels. And ESRS E1 is almost always material, which is important to note. This means that for ESRS E1, you have to have good evidence, basically, why it should not be material for you as an organization, otherwise it is material. And whereas for the other topics, you generally look for evidence as to why it is material, so basically the other way around. Then a quick visualization of how the layering of the ESRSs work, where you see here there's the topic own workforce, and then subtopic working conditions, subtopic health and safety. And as mentioned, that the IROs have to be broken down. We see here that an IRO is the potential negative impact from exposure to substances of concern. So then moving on to thresholding, I'm going to give the word to Jasper.
Yeah, thanks, Matthijs. So what we talked about now is understanding how you determine the materiality of issues, of topics. But it's also really important, before we head into the ESRS, is to understand, well, how do you bridge the gap from these topics to the ESRS, and that's thresholding. So the materiality threshold is up to a company's discretion. That means that an auditor needs to understand it. What that also means is that an undertaking shall apply the relevant criteria using appropriate quantitative and or qualitative thresholds to assess the materiality of impacts connected to its activities. However, ESRS 1 does not prescribe how to set thresholds. So what this means is that it's up to the company itself to determine where the border lies between materiality and non-materiality. We'll dive into that in a second. And it's best practice to use a 5-point scale for the characteristics from both impact and financial materiality assessments. So we see a quick example here on the bottom right, where you use magnitude on the x-axis and likelihood on the y-axis, and it's ranked both on a 5-point scale. And based on the scoring that you give to these magnitude and likelihood per risk or opportunity, it is ranked somewhere in between low and very high. So let's have a look at determining impact thresholds. So these are based on the scoring given to the scale, scope, and irremediability, which together make up severity and the likelihood of materiality. So here you also have, once again, these two metrics, these two factors that together make up a nice materiality matrix. And then you can see whether it is in the material section or it is not. And once again, the severity factors are commonly ranked on a 5-point scale, whereas likelihood is ranked from 0 to 1. So these scales are based on evaluation scores determined by the reporting company. And as you see here on the right, we have some examples on how that can be done. So in Coolset, we have various examples that we provide our customers with. These are some. So for scope, we use these thresholds where you look from limited to global, and then descriptions are related to the specific ESRS subtopic that you're reporting on. So they're always relevant, and there's always several options. And of course, these are also sometimes just templates. So if you're a company that has a very specific situation, feel free to use your own evaluation scores, but do note that it is important to kind of give the auditor later on an understanding of how you've thresholded your materiality assessment. Same for likelihood. Here it's scored from very unlikely to very likely with descriptions that can vary from company to company, but it's important to note that it's also important here to not just say, well, it's kind of unlikely. No, you need to kind of threshold it. You need to say it's unlikely, because here in this example, it says some experts see potential, but overall consensus points to notable challenges. So these are good things to keep in mind when thresholding. Let's look at financial thresholds. So as Matthias mentioned, these are based on magnitude and likelihood, and magnitude is commonly ranked on a 5-point scale, and likelihood is ranked from 0 to 1. So magnitude is based on a binary financial threshold. So either you're over the threshold, which means it's material, or you're under the threshold, which means it's not material. And a good starting point for figuring out these financial thresholds may be the McKee single rule of thumb paper, which provides several thresholds. So you see here on the right these examples, which range from 1 to or 1.5 of a percentage of total revenues, 1% of equity, 5% of pre-tax income, or 0.5% of total assets. So these are just some examples to get you started. And let me give an example with one of these. So say you're a company that works in the agricultural industry, and you see that you have crops in Germany. And in recent years, Germany has been facing a lot of droughts. So one financial risk might be that your crops are subjected to these droughts. You produce less output, or it's more expensive to keep them, to provide them with the necessary water they need. So your costs increase, or your sales decrease. Either way, you look at this 1% of equity threshold and you say, well, based on the calculations we've done, within 2 years, these droughts are going to cost more than 1% of equity. And that would mean that for that reporting year, you're going to say perhaps it's a financial risk in the medium term, so between 1 and 5 years. So these are some ways to think about thresholding within the financial impact materiality. And it's good to note that these are some examples, these thresholds, but it's of course up to your financial team within the company to perhaps also think about some ones that are maybe more relevant to your company. So I just wanted to quickly visualize this for you as well. So I've made some examples. So here we have ESRS E3, water and marine resources, and we have water pollution from runoff water as an impact, as well as excessive water use. So the first example shows that it's a classification of negative and actual meaning that it's happening right now, which is also why there's no likelihood score. So you have a scale of 3, which means that it's quite a heavy impact on the surrounding people. The scope is kind of the far-reaching effect. So how far is it reaching? Is it really local, or is it more widespread? And because it's water pollution, runoff water, it might be a lake or a river that goes downstream, and thus the scope is quite big. It's 4, and the irremediability means how remediable is something, how well can you fix it? And well, once the water is polluted, it's quite hard to clean it up. So it has a score of 3. We aggregate, we average those, and we get a score of 3.3. In this example, I've used the threshold of 2.5 out of 5. Also good to note is that these thresholds are really up to your company's discretion. So if you want to use the threshold of 2.5 and that makes sense to you and you've thought about it and the auditor understands it, that's fine. If you're saying, no, well, we have a different conception of these numbers, we're going to use the threshold of 2, also works. If you say, no, we're actually quite lenient with the numbers, so we're going to use 3. Just to kind of show you that the thresholding is really up to a company's discretion. So at Coolset, we can advise our customers, but we are careful with giving definite thresholds because that is up to the company. Then the second example here quickly is excessive water use. So we see negative potential meaning that there is a likelihood score. So here we see a scale for the scope of 2, irremediability of 2, and a likelihood of 0.8. So if you average the scale scope and irremediability, and multiply with likelihood, you get a materiality score of 2.13, which means that it's under the threshold of 2.5, and for this reporting year, it's determined to be non-material. Yeah. Then we move on to financial materiality. Just real quick, I see a question coming in. I'll deal with. We'll have a Q&A at the end, but feel free to ask the questions in the chat box, and we'll go through them one by one in the end. So, financial thresholding. So we have the same ESRS topic, and here we have the financial effects, which are temporary water shortages and higher water prices due to scarcity. So for the first one, it's a risk in the medium term. It has a high magnitude because let's take the same example of the agricultural company. Water shortage might destroy your whole crop if not taken care of. So it has a really high magnitude, but it's also quite a low likelihood. So when you multiply those, you get a materiality score of 0.8, and it's thus not financially material. Then we look at higher water prices due to scarcity, which is a long-term risk, and it has a magnitude of 4 and a likelihood of 0.8, and with a total materiality score of 3.2, we do consider this to be material. Perfect. Now let's look at reporting. So once you've gone through these thresholds, once you've established which IROs are relevant, you need to report on the sustainability matters based on materiality. So two things need to be clear, and this is directly from the EFRAG. So we need to report on the process. So what stakeholders were considered, what thresholds, and why. And within the process, it's also good to note that you have ESRS 2, which asks a lot of questions on the process. So it's not like you have to go in there and kind of find a place to report on this. They do make it really clear, okay, within this question, report on the stakeholder process. Within this question, report on how you gather data. So it's quite digestible for customers or users of the ESRS statements to fill in these questions. And then we have the outcome, which is where we look at what sustainability matters are material. So it's not essential, it's not mandatory to report everything individually. You don't have to break down, for example, scale, scope, and irremediability, but you may do so. But it's important to help the users of these sustainability statements, so that can be stakeholders, but also auditors, to help them understand why something was considered material or why it wasn't. Here, one more quote from the EFRAG. The ESRS do not prescribe specific documentation, but it is reasonable to expect a certain level of documentation to be needed for internal purposes and help insurance providers to perform their work. So once again, you need to have a good documentation process for the insurance providers, which are the auditors, but also internal purposes, so that in subsequent years you can build on your methodology. So then we have a look at double versus single materiality. I've also faced this question in the past where I was thinking, well, if something is only material from an impact or financial perspective, what does that mean for reporting on ESRS? So it means that if it is single material, you may omit data points you deem not material, and you conclude that such information is not needed to meet the objective of disclosure requirements. So what that means is that there are still many data points you have to report on, which I'll get to in a second. But there are some metrics that might, for you, not be relevant. More about that in a second. And last point on this slide is you still need to report on the minimum disclosure requirements. So every ESRS topic has these MDRs, and you still need to report on them regardless of whether you deem a metric to be material or non-material. So these are important things to note. So then looking at disclosing the ESRS topics. So once thresholding is complete, you have the ESRS topics to report on, which are now clear. And then the question is, what metrics, disclosure requirements, or minimum disclosure requirements do you report on? So you have the MDRs, the minimum disclosure requirements, which should always be included for each topic that is considered material. Good to note, MDRs are reported on next to topic-specific information. So MDRs are actually quite standardized questions that ask questions on your actions, targets, and policies for that ESRS topic. So even if you decide something is single material, you have to report on it. If you do decide something is not material, then the MDRs can be skipped. So yeah, if a company does decide that you have, if you're answering these MDRs, but you decide you have no actions, targets, or policies in place, that's fine. You're allowed to not have those, but you do have to report that that is the case. And then the disclosures that you have to report on, irrespective of the DMA, is ESRS 2, which is general disclosures, which I mentioned quickly before, is where it kind of asks on the process of the double materiality assessment, which stakeholders were involved, and so forth. And then, for example, for only for ESRS 1 to 5, you have to disclose on IRO 1, which is the description of the processes to identify and assess material impacts, risks, and opportunities. So you only have to do that for E1 to 5, for S1 to 4, and G1. You don't have to do this. Moving on to the next question of which data points to include in your ESRS statements. So the ESRS, when you read the documentation, you'll see that they differentiate between shall and may. And that means that whenever it says shall, you have to report on these data points or these policies or metrics and so forth. When it says may, it's optional. And that means that if you do have that data available, it's good to disclose, but you don't have to report it. So we see this table on the right. We also see, for example, the table, the second column on the left, which says irrespective of DMA, the MDRs are not included in this list of data points. And when disclosing on metrics for a financial matter, a company, and here comes another quote from the IFRAG, A, shall include the information prescribed by a disclosure requirement if it assesses such information to be material, and B, may omit the information prescribed by a data point of a disclosure requirement if it assesses such information to not be material and concludes that such information is not needed to meet the objective of the disclosure requirement. So here, this once again reiterates the point I just made about these data points within single materiality, where you say, well, I don't find this material. One example that I have now is, for example, if you say there's a metric that asks about the total amount of hazardous waste your company produces. So if you do have ESRS E2 pollution as a material topic, but you don't have hazardous waste, for example, then you can disclose it as such. You say, well, I know this is a material data point, but it's not material because we don't have hazardous waste. So this is one of the examples. Just quickly going to take you through the table here on the right. So we have these ESRS topics on the far left. And then you see that for ESRS 1 to 5, there's mandatory data points to disclose regardless of the DMA. On the very top, you have ESRS 2, which is the general disclosures, which is the one I was talking about before. The third column shows you how many data points you have to report on per ESRS topic. And you see that E1, S1, and those are really the biggest ones within DMA. So do also keep that in mind. And then on the right, on the very far right, you have the voluntary DPs. So you see that it's not too many, but it is quite substantial, and it is quite useful for a company if you do determine that you want to report on these. So I also wanted to give you some examples of existing ESRS statements that are that we have looked at and we think are good and in line with the ESRS requirements according to IFRAG. So we're not going to go into them today, but do feel free to have a look at these to kind of connect the dots of what we're saying today to maybe how this looks once you've gone already through the whole process and produced one of these sustainability statements. So the first one is from Ørsted. The second one is from H+H, and then we have Scan Global Logistics, which is another organization that has produced this ESRS statement. Then onto the phased-in disclosure requirements. So these are basically make it easier for companies to ease into the ESRS because they mean that when you start, you don't have to instantly report on all the data points. You can ease into it. And there's three groups of companies that can basically that decide how your company has to report. The first one is companies with less than 750 employees. So here are some examples of data points you can omit. So on the first year of reporting, you can omit information on the social topics, and you can omit scope 1, 2, and 3 data in the first year of reporting. This list of examples is of course not exhaustive. It's from an Excel sheet from the EFRAG. If you want to find that Excel sheet, just send me an email, Jasper at Coolset. I'll be sure to send it over to you. And then you also have the first year of sustainability statement, where you can omit, for example, information on S1-11 social protection. And then you have the third category of group. You have the third category of companies, which is the first 3 years of sustainability statement. You can omit certain data points to report on, such as, for example, for E1-9, you only have to report on qualitative disclosures, and after that third year, then you have to also start including quantitative disclosures. So let's have a quick look at auditing. Auditing is the step at the very end of your reporting process. If you deem, if it's complete, you send it to your auditor. So the auditors are going to base their audits on the ESRS and DMA guidance documents. So what's in there is basically their holy grail. And the limited assurance principle will be applied. Limited assurance means that a auditor looks at something and basically has to give a negative recommendation. So they have to say that they didn't find anything to be misreported, which is less strict than the reasonable assurance requirements, where a auditor gives a positive recommendation and they say, well, we've found that we're positive that there's no misinformation reported. So the limited assurance will apply for the next 4 years still, which is perhaps also a bit of a relief to some companies that are worried about this auditing process being very strict and stringent and putting you to the test. They will, of course, and you do have to report everything correctly, but they won't try and prove you wrong, because that's what reasonable assurance essentially means. Then until October 1st, 2026, limited assurance may be based on national standards. And after that, the EU plans to implement uniform limited assurance standards. What that means is that for now, companies or auditing companies base it on their own interpretation of the EFRAG. And after that, the EU will say, well, we have a standard approach for all EU companies, which will create a more level playing field. Then a conclusion of what I've talked about now. So you have the materiality and the ESRS. These are connected by IROs. Then you have the thresholds, which are based on hard metrics, but are also subjective based on how you score the thresholding. Then you have double versus single materiality, where you look at single materiality producing less material DRs depending on your specific circumstance. And you have the phase-in requirements, which give some companies the option to ease into reporting. Then we looked at ESRS, where we see that the MDRs are always mandatory, but it can also mean that some other data points are voluntary. And we have the audit requirements, which give us the confidence, or at least the peace of mind, that until October 1st, 2028, there will be limited assurance. And perhaps peace of mind makes it sound too easy. It's going to be really tough to comply with everything. But at least until then, it won't be very strict.
Perfect. Thank you, Jasper. I think that was very informative. Before we move on to the Q&A session, I already saw quite a few questions into the chat, so we'll get to them in a second. But I quickly want to go through how we at Coolset help companies become compliant with the EU CSRD regulation. So the integrated sustainability management platform, which means basically that we have 2 modules in which we help companies in this process, and we've tried to automate as many of these processes as possible and get towards that audit ready and compliant report. The 2 modules that we have are first carbon management, in which we help measure, analyze the scopes 1, 2, and 3 emissions and manage those emissions afterwards. And secondly, there's the compliance management module, which I want to discuss with you today, the EU CSRD compliance. Yes, compliance management. So we help companies from beginning to end, meaning that we start at the very beginning in the double materiality assessment with, for example, stakeholder engagement, where it is important to ask your stakeholders their inputs on the impact materiality and financial materiality of the topics that are relevant, and determine their scoring as we discussed today. As you see here, we have a progress report and a learning hub. So Jasper, as I mentioned, is part of a wider sustainability research team that is continuously creating content to make CSRD more bite-sized and understandable. These webinars help, but white papers and guides that we'll share with you as well are also a part of that. So moving on from the stakeholder engagement, we dive into the double materiality assessment, where we help you relate those scores and your own analysis or media analyses, for example, into the scoring part and determining which topics are material. So as you see here, we dove into the topic of energy, because this is a topic that's going to be relevant for many of you and many companies out there. So from the scoring you get back from your stakeholder engagement, you can score them on the several IROs that we mentioned. But the way that Coolset helps these companies is also by having two tabs that you see above at the right corner. Where there's supporting information, which is always a direct link to the ESRS legislation, and we highlight the part that is relevant to answer every question. And in a second tab, we have suggested answers, in which our research team has provided 3 different scenarios in ways you can answer these questions. This can be an inspiration or a basis on which you use to answer your own questions. So as a result from the inputs that you give in the double materiality assessment, we create the double materiality matrix in which you see the topics and how they're scored, and there you can see whether they fall into the areas that are material or not. At the top right corner, you again see the example of energy, which got a score of 4.67 on impact materiality, and subsequently a 5 on financial materiality, meaning that it's both financial and impact material and should be reported on in the ESRS. Now, moving on to that ESRS E1 climate change, and we dove into energy. There is a synergistic effect between the 2 modules that I mentioned. So we have the carbon management module in which we measure your scopes 1, 2, and 3 and your energy in an automated way. And subsequently, we also load all these answers into the compliance management module as well. So this makes sure that you are very efficient in the way that you fill this out and you work towards a compliant report. And as you can see here, there's a lot that's already pre-filled. And that was quickly a way to go through Coolset. If you'd like to know more or have a click around yourself, please send me or Jasper an email, and we'll get back to you on that. So that was the part where we talked a lot, and now I think we're gonna dive into the questions.
Yeah, we're still gonna talk a lot, but so yeah, as promised, we'll go through the Q&A now. So we'll look at the questions that you've asked, and I'll try to give you an answer that aligns with what we do here at Coolset. First question that I see here is from Yasar. So how would you quantify softer topics financially, such as working conditions? Really good question. Also something that we've asked ourselves a lot at Coolset. Basically, you have to see if within these subtopics or subtopics you find financially material risks or opportunities. So say working conditions, one risk that I could think of now is that the working conditions are bad and that your employees decide to jump ship, so they quit. So one risk that you could then think of, well, is, okay, how do I quantify the financial risk of if I have a 10% turnover rate per year, so 10% of my employees leave every year, how do you turn that into kind of a financial cost? So you can say, well, it costs so many €1,000 a month or a year to retrain employees or to do recruitment. So here I would say, you could then sum up that number and maybe turn it into a percentage of your total equity or your total income. But it is, of course, also possible to use different thresholds. So the examples that I mentioned, they're very, very relevant for some topics, but perhaps for this topic, you could also consider a different threshold. That's really up to your company's discretion. I see here a question from Claire. Can a topic have both a potential and a negative impact? Definitely. So you can have, we have within impacts, you can have 4 types of impact. You can have actual positive, actual negative, potential positive, and potential negative. And these can all happen for an ESRS or for a subtopic. So it's not like only one can happen. So they can also happen together. So for example, here you ask the question, can it be a potential and can it be negative? Definitely. So say you're worried about being polluting because you have a chemical facility and it might at some point break because you have a reservoir with chemicals. That is a potential negative impact if it does break. So these are things that you can consider. Question from Anna: Do we do double materiality analysis at the level of general topics or subtopics? If subtopics, then I understand that not all subtopics and from the main points are automatically relevant. Good question as well. So we ask at Coolset, we work basically with subtopics, including also the subtopics, so that you're always aware of what's going on, what subtopics could be included. It depends on your long list as well. So first you look at these IROs and you say, well, these subtopics are definitely relevant, or these subtopics. So you do not have to include all subtopics in your analysis. I hope it makes sense with the amount of times I'm saying subtopics. But this is basically, so the process is you make a long list of IROs, connect that to your subtopics, then you report on those. And within that, you can also say some are automatically relevant or material. If, for example, we go back to the example from Thijs, where some issues might be clearly relevant, then you can also mark that as such also in the Coolset platform. I hope that answers your question. Kasia asks, will the recording of the webinar be shared with us? Yes, it will. You'll all get an email with the recording after this session. Adela asks, voluntary DPs are the ones saying that undertakings may disclose. True, yeah. So if it says may instead of shall, it's voluntary. Question from Brecken. Are the examples shared available in a centralized place, or where can we access these? If it's the examples from the sustainability reports, you can find them all online. So you have the Orsted, the H+H, and the Scan Global Logistics. But also, if you want, you can send me an email at jasper@coolset.com, and I'll send you some more examples, also maybe some internal examples, and I'll answer all of your questions. But as of now, we share this mainly through the webinar and don't have an article about this, for example. But it is a good idea. Maybe we'll start doing that.
Yeah, if it's concerning the previous webinars, for example, or anything you saw specifically in the presentation, just shoot us an email and we'll get back to you with that.
Yeah. Maria asks, does Coolset have the possibility to display both location-based and market-based greenhouse gas emissions, or at least switch between them easily? So for those that are less familiar with these terms, location-based greenhouse gas emissions, which are Scope 2 emissions, refer to electricity consumption from general purchases that don't specify where it comes from, whereas market-based really states, okay, I bought electricity from Vattenfall and it was 30% wind, 70% gas, for example. So within our Coolset platform, it's possible to upload a location-based and also upload the emissions for market-based data so that you can see the difference between both. If you want to know more about it, once again, feel free to send me an email. Got a question here from Sophie, which is, let me see, it's quite long.
She also said it's partially answered already below,
Okay.
but maybe partly doesn't mean fully, so maybe we can still go through it.
So I see the question in the end, how large are financial effects? How do you know whether temporary water shortages will have a high magnitude related to the threshold? Let's see. Yeah, good question as well. So it is quite complex to estimate whether something is financially material. Also good to note here is that these don't have to be 100% certain. So what you can also do is work with proxy data. So you look at, for example, competitors and how they have calculated things, and you can use that, especially in the first year of reporting. It's acceptable to use it. So that's the first thing I want to note, is that you don't have to do the calculations based on hard data only. So the high magnitude can, for example, be if you have various scenarios where you say, well, the temporary water shortage leads to a substantial loss of the amount of crops that we have. Let's say you're an agricultural company, and you say, well, we lose 5% of our crops in the next reporting year, and 5% of our crops translates to so many millions of euros, and that translates to X percentage of our equity. And if it crosses that threshold, that's considered material. Once again, just like the question I answered before, these thresholds aren't the only thresholds you can choose. If you feel like something else is more relevant to you, you could also have a conversation with your financial team, for example, and they might be able to tell you, well, actually, with our financial structure, it makes more sense to consider this threshold over that one. Does the CSRD compliance solution export? Maybe that's a question for you.
Yeah, so we do it in XBRL, PDF, and Word at this moment, and XHTML. I'm not sure if we do it already, but I know for a fact we do XBRL.
Perfect. Okay, and then I see one more question from Yasar. I think it might relate to the first question. Okay, so you have. So you can have different thresholds for different topics / subtopics. Wouldn't this then result in a weird matrix as you would rate topics X with A thresholds, but topic Y with B thresholds? Yes, it's true. So ideally you would kind of stick with one type of threshold, but within financial thresholds, for example, you don't always have to say, well, I only look at 1% of equity, or I only look at 5% of pre-tax income. You can switch between those. It is good then to note where you switch and where you argue this, because as the IFRAG notes, there is no one way to do the double materiality assessment. It's up to the discretion of the company how that threshold. So what that means then is that if you do decide to go for different thresholds, you need to report that process and you need to document it so that the auditor will have a look and understands, okay, well, this threshold was used differently, and they understand why that was the case. If the auditor doesn't understand it and he thinks that you were cherry picking or basically just doing it so that you could get out of considering something's material, then of course he will give you a review which doesn't align, or basically he won't validate the audit. So it's always good to report, always good to document, and good to know also that you can have several thresholds. Any more questions?
By the way, if any questions come up in 16 minutes or 15 minutes, or when we've closed the session, it's of course also still possible to send us an email with the questions, and we'll get back to you with a detailed response.
Yeah, for sure. And also feel free to add us on LinkedIn. Maybe it's also a bit of a lower barrier to reach out to us there. And we do also post there the most up-to-date content on the CSRD. So yeah, just wanted to mention that. If there are no more questions, I think we can finish today's session. Thanks to you, everyone, for joining us. We hope you learned something new, and we hope to see you at the next event. Thank you.
Thanks.
Bye-bye.